Hello members and welcome to today's macro webinar from Fat Profits. It's Thursday, 6th of July, and we're now into a new financial year. There's lots to talk about today, looking back at a little bit of last 12 months and looking forward to the next 12 months. My name is Roger Malik, the host for today's webinar and the head of client services. Joining me today is, of course, our main man of Fat Profits, the founder of the company, CEO and fund manager, Angus Geddes. Angus, welcome to today's webinar. As usual, how are you?
Very well, thank you, Roger. It's always good to be on the webinar with you.
Great, good to have you on board. New financial year. Wishing everyone the best of luck in the next 12 months ahead. Before we get into today's deep dive into the markets and looking at details of where we see the markets going. A bit of disclaimer, all our presentations from Fat Profits are general in nature. We don't provide any personal advice. If you're looking for that, please see your financial advisor. And also past performance is no indicator of future performance. Now, of course, it's live today, so you've got a chance to ask one question apiece. We've got a Q&A session at the end of the webinar. Of course, if the question is burning topic, we'll ask that question during the Q&A session. We'll do our best to answer as many as we can, so feel free to take the opportunity later on today. So first thing first, let's have a quick look at the market snapshot from last week to this week, and you'll notice that the US markets have gone up, especially the NASDAQ continuing its strong run, followed by the S&P and the Dow Jones as well. The ASX, while it's been up slightly in the week, but I think we've given up most of those gains today. We're down about 1%, so we'd say we're flat in the week, in spite of a pause from the Reserve Bank. China continues to grind a little bit higher, although down quite a fair bit this year, and FTSE's a little bit down as well. Now, as we said earlier, it's the new financial year, so we'll have a quick look at how we've performed in the last 12 months. So the ASX 200 and the All Ordinaries pretty much bang on 9.7%. Let's round it up to 10% for the last financial year. So you'd say, look, it's not too bad. I guess 10% on an average per year. You'll take that, of course, from one year to the next as a broad performance. However, if you look at how we performed versus the global markets, you will notice the blue line is the ASX 200, the orange is the NASDAQ, followed by the red, which is the global index. And of course, you'll notice over the last 12 months, there was a period where the ASX was leading the way, and we were far ahead of the NASDAQ as well as the world index. This is when things were falling, and ASX was holding up pretty well up until sort of October, maybe November last year. And then we've seen the AI frenzy, NASDAQ really leading the world indexes, followed by the global markets. And ASX actually, unfortunately, fallen behind in that little curve. But nonetheless, look, you'll take the positives when you can. Also looking at the last 5 financial years, and this is quite a bit of an interesting one. From 2018-19, you know, we've gone up one year, down the next, up one year, down the next. So the last 12 months we're up, and this is including dividends, by the way. So this figure includes ASX dividends, and we are one of the best dividend-paying countries in the world. So if history was to go by, and if it was as simple as that, well, the next 12 months don't look very good. We might end up being in the red if this trend was to continue, but of course, things don't always work out in that fashion, do they? So just something to be aware of, to look at. And this is the snapshot of the last 12 months worth of sector performance, and quite interesting because of course tech stocks have now led the way. 37% IT sector has really jumped, followed by utilities and materials. The worst performer, which is still in the green, but real estate, and you can understand why. So Angus, maybe I'll get your insights firstly on how you think the last financial year has been for the ASX, but also quickly looking at these sectors We know tech has really performed well, mostly in the last 6 months. But how do you see these particular sectors? Are you looking at any particular sectors going forward? Hopefully, when the markets are bottomed out, when you're ready to buy, are there one or two sectors in particular that stand out for you that you're keeping a very close eye on?
Yeah, look, I think you know, materials and telecoms and consumer discretionary. I mean, they were in the better performing um, or the top performing six sectors. And you know, I still like, you know, we still like telecoms, still like materials, but I wouldn't be rushing out to buy them today. You know, and if we look at the you know, the ASX 200, I mean, it has done well, but it's pretty much in a range. We've been fluctuating in a range now for some time. And obviously, you know, if we look at the leader, which is information technology, obviously we've had this huge rally in the Magnificent Seven and these tech stocks in the States. And of course, the info technology stocks in Australia have followed those up as well. So I guess that's one sector I'm a bit cautious on at the moment, particularly with those 10-year bond yields or bond yields just generally breaking out on the top side. But I think there's going to be some good opportunities, you know, looking out in the second half of the year. And, you know, just sort of keeping powder dry and waiting for the opportunity. I mean, no bull market ever started when the central banks were still raising rates.
Thanks, Angus. That sounds good. So moving on to, and I've got a couple of comments from members saying the screen might be a bit smaller today. I'll come back to that in just a second, but just moving on to the big news of this week. Of course, the Reserve Bank have paused on further rate hikes and kept the rates at 4.1%. While this is welcome news, of course, for mortgage holders and renters alike, you know, you can see the big trajectory of the last sort of 14, 15 months. We've gone from nearly 0 to 4.1%. So on one side, yes, it's a bit of a relief for the short term, but of course, you know, we're not out of the woods yet, because if you compare the Australian cash rate versus inflation, which you can see here, cash rate 4.1, inflation 5.6. This is just headline inflation, by the way. And you compare that to the rest of the world, you know, our cash rate is still below our inflation rate, where if you see the US and even Canada, for example, they're starting to get a little bit more on top of inflation. Angus, your thoughts on the Reserve Bank? Was that a bit of a surprise? And how do you see the next few months now? Still see further rate hikes?
Yeah, I was a bit surprised. I thought they were going to go 25 basis points, but I mean, it's really a moot point, because you know, they skipped one, then they put one in, then they skipped one, and they'll probably put another one in August. And I think, you know, if anything, it's becoming very political. You know, there's not a day that goes by that we don't hear, you know, how hard the community's doing it with respect to the mortgage belt. And, you know, the government has been, you know, a little bit vocal about it as well in terms of the RBA raising rates. And of course, you know, the RBA on the other side have got to balance the risks of inflation in an overheating economy, or an economy that's got significant upward price pressure. They've got to balance that. So look, I think it doesn't really change anything, and the RBA is still going to have to keep tightening and get that cash rate north of 4.1% to really cool inflation down.
Okay, thanks, Angus. Sorry, I'm just trying to fiddle with the screen, because I've been told by members that only seeing a little bit off the screen. Angus, since you can talk, can you see the full screen now?
Yes.
You can?
Yep.
Okay. All right, so apologies, members. So I was just trying to work with technology. Something's changed today. I'm not sure what that is, but as long as you can see the full screen now, we're back to normal business. So apologies for that little technical issue. All right, we'll move on then. In that case, look, I think your point is quite valid, and I don't think there's anyone who believes that we're out of the woods in terms of further rate hikes. So there's probably one or two more to come. Can we talk a little bit about real estate today, Angus? Because of course, a lot of investors in Australia, as you know, I'm talking about share market investors, probably own some investment properties. I'm sure some of our members do, or people renting. So this is an important topic, and what we're looking at is on the left-hand side, you can see the prices, house prices have started to go back up, and this is just a monthly change from previous figures. And if you look at one of the key reasons why that is because supply has been very subdued, and you can see the orange line on the right-hand side. The listings have been very, very few. Now, that's one thing which is driving house prices higher, even though rates are going up. And rental vacancies, on the other hand, are extremely low. This is a multi-decade low. That's a problem. We understand what's causing it. And now you're starting to see new home loans also starting to get more and more approvals. People are getting desperate. They're rather more interested. A lot of investors are now starting to dive in as well, and they're brushing aside these rate hikes that we have seen. And we know that there is a little bit of a mortgage cliff coming now, with a lot of fixed rate loans coming off fixed rates and now into variable. And you can see this particular chart which shows you what's happening there. There's a huge chunk of them in the next 3 or 4 months. So can we get your thoughts on the real estate market? These investors that are now starting to buy, would you be one of them? And would you be looking at buying any real estate stocks at the moment, or would you rather wait another, 6 months, 12 months? What are your thoughts on the real estate market?
Well, I mean, I can understand why the house prices are moving. I mean, when your rent's gone up 30%, or you've been made vacant, I mean, it's an insecurity really, and I think that's driving people to rush out and buy their own home. There's a real crisis in the rental industry with rental properties available, at the lowest level in decades. And so I think that's what's driving it. But I would be very cautious in terms of buying investment property as it relates to residential. Just at this point in the cycle, Roger, I'd be waiting for the RBA to have stopped hiking and wait for them to start actually almost cutting before it's time to get into residential. I mean, what could upset the apple cart? Well, there's a couple of things. First of all, as you pointed out, there's a big chunk of those mortgages that are rolling off. We're in the eye of the storm now, as it relates to Australia, where mortgages are going to be refinanced at the current variable rate and coming off low fixed rates from a few years ago. So that's really going to begin to bite. And the second factor, of course, is the probability that Australia will enter a recession has gone up. And if Australia does enter a recession, unemployment's going to rise. That's going to put downward pressure on housing. So now's not the time to be investing. I would wait till we're through the cycle and the RBA starts to cut rates, because the economy is doing it tough. Inflation's under control. And I would be waiting and biding my time. So I still think it's a bit early.
Okay, all right, I agree with you. And look, the other thing which I think the RBA is certainly looking at, we talked about this recently, is the unit labour costs, productivity being low, but the unit labour costs have certainly gone up to 10-year highs. And the previous time there was higher than that, other than, of course, 2020, was in 1989, and that was followed by a big recession. So this is something they're worried about, something they're trying to control. Onto the ASX 200, before we move on to outside of Australia. We talked a fair bit about Australia today, but the ASX 200 still above 7,000 points. I know we're down about 1% today, but all in all, still holding up all right. Yeah, the last few months have been going up and down, really not going anywhere. So one might say we're just pretty much running on the spot, on a treadmill. But how do you see the ASX at the moment? Do you see a little bit more further downside in the coming months, or?
Look, I think we're in the middle of a range, Roger, and that range is yet to be resolved, and it will be dictated by whether we go into a recession or not. So, you know, if you think that Australia is going to completely avoid a recession and that the RBA will be cutting rates by, say, the end of the year, you know, you'd be thinking that the ASX 200 is going to run away to the top side if the worst of the uncertainty is behind us. But if you're like me, and you know, I think that we've still got some challenges in front of us. You know, the RBA is still in a tightening cycle, and that I think, you know, the economy. I'm not going to say we're headed into a recession, but there's a significant probability that we could enter a recession. You know, I think that the risks are still to the downside. So I would be biding my time and waiting for the opportunities in the next 6 months. I mean, I've just got to emphasize this enough. No bull market has ever started in history when the central banks have been raising interest rates. I'm yet to see that happen.
I think that's a very important point. Because
bull markets start when typically when the recession starts, at the beginning of a recession, and the central banks move to a easing bias. And I reckon that playbook is going to repeat. You know, I think this is quite a common playbook. And yeah, I mean, you know, there's the debate about whether we have a soft landing or a no landing. But, you know, if you look at the magnitude of the interest rate rises and the way the economy is behaving, and you look at the spending high that the economy has been on from the pandemic and all the fiscal stimulus, I mean, all of that's unwinding. So, you know, we've still got tighter interest rates. So, you know, in terms of the ASX, I think the best action is to proceed with caution and just wait, keep the powder dry, wait for the opportunities.
All right, thanks, Angus. Moving on to US now, and let's talk a few things here. First thing first, the minutes of the meeting from the Federal Reserve came out yesterday. Bit of a non-event, pretty much what Mr. Powell has been saying for some time was pretty much reiterated. All the participants are pretty much on the same page, and they're looking at 1 or 2 more rate hikes. So that was really a non-event, didn't really move the markets, but something that now the markets are pricing in, that's changed. So now they're looking at a 86% chance that there will be a rate hike later in this month, in July, versus 13% who think there'll be a pause. So that's changed from a month ago. And what's also changed is now the outlook till the end of this year. So up until December, now the chances are, market is pricing in, 51% chances are that we'll stay at the current rates, which is basically 1 more rate hike, 5.25 to 5.55%. So it'll be 51% chance that that will be the case by December, and 29, well, nearly 30% expecting 1 more rate hike after that. So basically, majority of the market is expecting 1 or 2 more rate hikes by the end of this year. Would you be in the same camp, Angus? Would you expect 1 or 2 more rate hikes by the Fed?
Look, I think they will go at least 1 more time, and I think there's a good chance that there's maybe even a second rate hike lying out there in September. You know, given where the labour market is, and given how strong it is, and given you know, that the inflation rate is still miles above target, and you know, it's having a slow time of it getting back towards target. So I think, you know, I'm sort of in the there's more wood to chop camp as it relates to the Fed.
Yeah, absolutely. Well, the other thing, what's happened since the last few weeks, and I know you've been talking a lot about it in your daily Fat Chat, is the bond market. And the bond market is clearly now saying that the yields are going higher, rates are going higher, and the probabilities of recession are getting higher as per the bond market. That is, the equity market, on the other hand, is absorbing all that in, and credit where it's due. The share market just continues to not budge, which is very, very confusing I think, for most investors. But talk about the bond yields, Angus. The bond yields are rising, and the equity markets are not falling. How do you see this relationship?
Couple of points. Yeah. Normally, when the yield curve is inverted, which it is at the moment, it's because there's a recession approaching, and we've got a situation where when a recession starts, the Fed typically cuts rates. I think this cycle is going to be a little bit different, and it's complicated due to the fact that the labour market has been so strong, and you've got those wage price spiral pressures manifesting itself in behind the scenes. So that's the typical setup, and I think this cycle is proving to be a bit different, which is why we're seeing bond yields now break out on the top side. There's some additional things going on behind the scenes, and of course, one of the drivers of the higher bond yields is this massive Treasury issuance program that's underway now by the US Treasury to fill the coffers. I mean, they're issuing sort of 1.2 trillion in new paper and new bonds, which is putting upward pressure on yields. So, we've got a situation where not only is the Fed probably going to have to keep rates higher for much longer in this cycle, but we're actually seeing the long end of the yield curve sell off. And, typically, higher 10-year bond yields means lower valuations for technology stocks and growth stocks, which are particularly rate sensitive. Now, just on this inverted yield curve graph, Roger, it was interesting because JP Morgan did some work on this, and they noted this week that a recession, from the moment the yield curve goes negative, that's the difference between, say, the 10-year yield being below the 2-year yield, or the 10-year yield being below the 3-month rate. Typically, within 12 months of the US yield curve inverting, you get a recession. And,
yes.
They've made the comment this week that we're right on that 12-month mark right now from when the US yield curve first went negative. And it's a big inversion. It's not a small inversion. It's one of the steepest inversions we've seen since 1981.
Yes.
So you could make an argument that the recession's really already begun.
Yeah, that's a worry, and it's still not reversing yet. I think that's the other thing is, and you can notice this in previous recessions, which are the long grey bars, is the recession really only arrives when the inversion starts to basically become straight. So it reverses course, which is when the rate cuts happen. And that's what, Angus, you made a couple of points earlier, is when rate cuts arrive, that's basically when the recession or something bad has happened. And I know that we're not close to rate cuts yet. So this is getting pushed out. This time is slightly different, I guess you can argue. It's getting pushed out a little bit longer. This is a long drawn out, very slow motion like bear market. And looks like it's going to be another few months before we see the recession bells start to ring. So
yeah,
something to keep in mind. But I think the other key point, Angus, is you mentioned about the tech versus the 10-year bond yields. Well, this relationship has gone quite parabolic. If you look at the black line, that's the tech stocks in the US market, and you use the blue line, which is the 10-year bond yields. There is a huge disparity there, and that's not normally the case, as you can see in the past. So something's got to change. Either the bond yields start to change, or the tech stocks start to come down. And this is something you put out in the daily fact chat the other day.
Yeah, as you say, Rog, there's a big disconnect. I mean, something's got to give. I mean, the correlation between 10-year bond yields you know, relative to the S&P 500 technology sector, has been very, very tight up until January of this year. And we've seen this huge gap open up. So, you know, either, you know, I'm missing something completely, and, you know, 10-year bond yields are going to collapse tomorrow, justifying where the technology sector is at the moment, or tech stocks are going to come down. I mean, it's really going to be one or the other,
Yes.
because this correlation, you know, historically has held true for, you know, it's a very tight correlation, which has been around for a long time. I don't think companies on multiples of 50, 60 times are going to be able to ignore a 10-year bond yield that's about to go through 4% for too much longer.
So I guess the underlying message, so that members can truly try and understand what we're trying to say in simple terms, is we're anticipating that the high valuations, and you can see the valuations, talking about valuations right here, you can see the gray line, which is the mega cap tech stocks. So you've got the Apples and the Microsofts and the Amazons, and that's really what's led this year, the last 6 months, of gains, not just in the US markets, but basically pushed some of the other markets around the world as well, along with that. And that's gone up to valuations of 30 times earnings. You can see that on the right-hand side, versus the rest of the S&P 500, which is at 17 times earnings. So again, you see a wide gap between these top 7 stocks versus the rest of the market. And I guess what we're trying to say, Angus, and please correct me if I'm wrong, is that because of the high valuations, these companies are going to have to really justify these valuations by having unbelievable earnings in the next 1 or 2 quarters. And if they're able to do that, maybe the market holds up. But if they're not able to do so, then the market comes down, especially these big tech stocks, and that presents opportunities for new investors to get back in the market. Is that how we should read it?
Yeah, I think that's exactly how we should read it. And I'd also add that, you know, what happens if the 10-year bond yield breaks out on the top side and takes out those October highs last year? And, you know, I say that because the consensus believes that bond yields are going down, that bond yields are going to be lower 6 months from now than where they are at the moment. But if you look at the technical patterns, and we put up, you know, a number of technical analysis charts today of the US bond market, I mean, the technicals are saying that it's going higher. So, you know, just as we had to respect when we went tactically bullish in October last year, when the S&P 500 got down to that big support level at 3,500, just as we had to respect that, just as we had to respect in December and January of this year, and February, the rising probability of a breakout in the S&P 500 above that 4,200 level, we also have to be respectful now of what's going on in the bond market and what the bond market's signaling. And you know, the one takeaway that I really want to stress today is that, you know, rising bond yields not only mean tighter financial conditions and reflecting tighter financial conditions, but, you know, it's trouble for stocks, and it's trouble for these mega cap and these growth stocks and these tech stocks in particular. You know, these companies with these very, very high valuations that are massively rate sensitive.
All right. Thanks, Angus. We know what's going to happen if they come down. But before we look at the S&P and a couple of charts, this was also quite interesting because you put that in the daily fact chart, the current positioning, because you know, for mums and dads, they might not understand this clearly. But if you can explain to us, what does this explain in terms of positioning for fund managers, asset managers, and also sentiment as well? Because this pretty much explains a few things.
Look, just summing it up in one paragraph, where markets were bearish 6 months ago in December, the AA, bull-bear spread, we saw that down at sort of minus 30%, which represented a bearish extreme in the fourth quarter of last year. We're now in bullish territory, pushing up towards, peak bullishness. Not quite there yet, but heading in that way. If we look at the positioning of US asset managers in terms of equity futures, we can also see that fund managers and hedge funds have gone from being having very low positioning to very high positioning, which is really up around the historic highs of where things were just prior to the pandemic, and after that big bull run from the pandemic lows up to the highs of 2021. So the positioning and the sentiment, it's not offering a safety net anymore. FOMO is now in full swing. People are scared of missing the rally. This is about greed and fear. Fear has been displaced by greed, and the pendulum has swung within 6 months. So caveat emptor. Caveat emptor. I think looking out over the next quarter into September and October.
Yeah, absolutely. Good point there. And that brings us to the S&P 500. So yes, we know it's gone past the 4,400 previous resistance, is now around 4,450. How do you see the setup? And also I might throw a question which has come through from one of the members, Kev. He's saying, hi Angus, is now a good time to short the S&P 500? And have you reinstated shorts in your SMAs?
No, we have not reinstated shorts. We took our shorts off 3 or 4 months ago, and I think that was the right call. Problem is, and this is trading. Does the FOMO rally extend for another 100 points or 200 points, or are we seeing the peak right now? It's difficult to say. But if you took a view that you were maximum long invested, now it'd be a good time to be cashing up and accumulating some cash. If you've got some cash already in your portfolio, and we've been carrying some cash for some time now, now's not the time to be deploying it. But if you said to me today I had to make a bet, I'd be saying, well, yeah, 4,450, 4,500. I mean, how much more upside risk is there, given all the headwinds that we've been talking about today on the webinar?
Yeah, agreed. And look, one thing I will probably also say, Angus, because I think a lot of our members who've been with us for many, many, many years, they would know that historically speaking, not only you, but all our Fat Profits team are very optimistic. We've always been bullish on the markets, because long term, of course, if you are in the right stocks, or even the index in general, always goes up long term. So historically speaking, we're very optimistic, always see the half glass full. However, over the last sort of 9 months, maybe 10 months or so, maybe up to 12 months, this is probably the first time in the longest time that I can remember where Fat Profits have been more bearish than bullish. And I guess based on the fundamentals, and that's how we see things, and our job is to call it as we see it. And because the way we see the economy and underlying headwinds for not only just the economy, but also for the share markets, I guess this is the first time in a long time for you as well. How do you feel about looking at the markets in a different perspective? Because normally you're extremely optimistic.
Yeah, look, we normally are always optimistic, Roger, and particularly around crises in the markets. I think that it's fair to say that we've always been there on the buy side when trouble has hit. It's just that near term, the risks are higher, particularly now that the market's got higher. People have become more greedy, and naturally we've become more cautious. And I think that there are going to be some great opportunities, but I think we've got to wait for those opportunities and wait for some sort of break in the market. Just remember, and I'll just finish on this, No bull market has ever started in history when the Reserve Bank or the central banks have been raising rates. Typically, new bull markets start when they're cutting rates, and typically they cut rates because there's a problem with the economy. So just bear that in mind, and bear markets bottom on despair. And I think that the lows that we saw in October, I think this big rally that we've seen is probably a correction of the bearish positioning that we had. I mean, it was the most talked about recession in history, most anticipated, and I think a lot of that's now washed through the system. So I'll wrap that question up on those comments.
Yeah, very good, Angus. I think that makes a lot of sense. And I know a lot of our members agree with you as well, by the way. Not everyone, I don't think anyone can expect everyone to be on the same page, but I know we've done a survey in June and most members do agree with your assessment of the economy. Look, we'll power through a couple of other indicators today because we're conscious of time, but this is something you put out in the daily fact chat. Goldman Sachs put out a year-end target for the S&P 500, and best case scenario, if they get a soft landing in the US, you're looking at 4,700 points. So currently, keeping in mind we're at 4,450, so you're looking at another 7% rise from here. Whereas the worst case scenario, if the recession arrives, then you're looking at a big drop, a 23% drop of 3,400 points. So I guess the risk versus reward is what you need to look at. So a lot of the good news has been priced in already, and if all things go well, probably looking at a small percentage gain from here, but the downside risk a lot higher. So that's something that we're conscious of at Flat Profits, and that's, I guess, one of the key aspects of why we're defensive at the moment. So something for you to consider. And Russell 2000, look, this is a small cap index in the US. And as Angus has pointed out a few times lately, when a bull market arrives, and pretty much the breadth follows, and all markets, all indexes follow. And small cap index is not following at the moment. It's just barely off its lows. The outside of the top 10 companies in the US, you look at the other S&P 500 companies, they've only gone up 1% this year. So all those other things, if you really go beneath the surface, you'll notice that it's not as rosy as you might look at the headlines. So that's something you have to also keep in mind. And the last couple of points before we move on to China, because we do want to talk about China as well today, is the manufacturing. And this is something which has made some headlines in the last probably 2 or 3 weeks. And global manufacturing is slowing down. And this is a key aspect for an investor to look at. This is a chart of the euro. And you can see now we're getting even lower than pre-COVID. So that's not a good sign for the economy. You look at breakdown of countries. So UK is now coming down quite rapidly. You look at US. Yes, that's also slowing down as well. You can see the numbers speaks for itself. Germany, which is in a technical recession already, PMIs are now falling at a pretty solid pace. So that's something to keep an eye on. And Australia, look, while we're not as bad in terms of manufacturing, but we're also slowing down as well. The PMI is slowing. So that's something for you to be aware of. And also the logistics manager index in the US, that's come down to now multi-year lows as well. So there are a few things that we always look at Fat Profits. Factory activity in the US, and this is something I think you put out a couple of days ago in the daily fact chat, and a lot of research goes behind the scenes, but this is again dropping down to levels we haven't seen for many years. Maybe a quick thought on that, Angus, because this is something that I know you certainly look at and many investors do. A quick word on that?
Yeah, I mean, look, if we look at the this is really talking about the key engine room of the US economy, manufacturing. And the data is in trouble. It's pointing to problems within the economy. All this ordering and overspending by consumers, over ordering by companies, over manufacturing, building up to a certain level of demand that was there 2 years ago, 3 years ago because of the pandemic and because of all that forced savings and the fiscal spending by the governments that went directly onto people's balance sheets, I mean, that's all washed through. And companies are now having to tighten their belts. They're not getting the same amount of orders. The economy is slowing. People are not spending as much on durable goods anymore, still spending on services, but not on durable goods. You know, it says to me that the cycle's looking very fragile indeed in the US. And we may even look back 6 months from now and say the recession, you know what, the recession actually started in July 2023. So this is something to be mindful of.
All right, excellent. Thanks, Angus. Now, moving on to a couple of other points. Look, home sales is something to keep an eye on. Home sales are also slowing down quite rapidly, in fact, in the US. So this chart really shows you they're now down to even levels below from pre-2008 housing crash. So home sales are really starting to crash, if you like. I mean, this chart really, there's no other way to put it. They've actually gone down quite a fair bit. So something to keep an eye on. Look, this is important for investors. The US dollar, it's holding up pretty okay. I guess with 1 or 2 more rate hikes to come, looks like US dollar will probably hold up for the short term, Angus. What are your thoughts?
Yeah, I think that's a fair comment, Roger. It's converging within the dollar index is converging within a triangle pattern. These are typically resolved with a fairly dynamic breakout. Contracting range leads to a dynamic breakout on the top side or the bottom side. So, but I still think that 105 will cap it on the top side. Interest rate differentials are rising again in favor of the US. You know, with the bond yields rising and the Fed likely to tighten again later this month. But, you know, the rest of the world is catching up. You know, we saw the Bank of England raise rates by 50 basis points. So I still think looking out over the medium term, the US dollar reasserts to the downside. And I think that will be good for precious metals and commodities generally.
Okay. All right. And before we talk about China, just a quick word on oil as well, because oil is just nudged back above $70 a barrel. And it's to talk about production cuts in the Middle East. So, of course, the central banks don't want to see oil go back up to $80, $90, or $100 because that'll add fuel to the inflation fire. How do you see the oil price?
Look, I've been cautious towards oil, you know, given the deteriorating outlook in China, the slowing global economy, you know, the rising risks of recession. I've just been naturally cautious on oil for most of this year. And every time it looks like it's going to break down below that sort of $65 support level, we get a cut from OPEC. You know, we've seen Saudi Arabia and Russia move in with a decent production cut this week, which has forced oil up. So I guess what this is sort of telling me is, one, there's a floor. There's a natural sort of a floor that's under the oil price, and that OPEC. Secondly, that OPEC have the ability to actually defend the oil price and manipulate it, which wasn't perhaps there 10 years ago when the United States was the largest swing producer and we had fracking, the fracking oil industry, you know, operating at sort of, you know, peak capacity. So I think there is upside risk to the oil price at some point. You know, I'm not saying that's tomorrow, but, you know, looking out over the medium to longer term. And of course, you know, if we did see oil break out above the sort of $75, $80 level and inflect to the top side, then that takes us right back to the beginning of the inflationary cycle, because we know that, you know, energy prices are inflationary. Now, they've been a deflationary tailwind for the last sort of six to 9 months. You know, they've been declining. That's taken a lot of the heat out of the CPI, but you know, if they reverse to the top side, then that can actually reverse the positive trend that we've seen in inflation. So it's bear it's worth keeping an eye on. And I think, look, fundamentally, the price setup for oil, I'm actually quite bullish on it over the medium to longer term. You know, we've seen all this underinvestment, political ESG issues have knocked the industry for a six in many economies, and we're just not going to see the new supply and the money going into exploration. And of course, that sets up a squeeze. Yes, the world's moving to electrification and renewables, but that's all going to take time. It's going to play out over 15 to 20 years. You know, in the meantime, the world is still going to run very much on oil. So, like this will be one set. We talked about one sectors that we like. What are we sort of waiting for? You know, I've been looking to add to my my energy position when opportunity presents itself.
Absolutely. Energy has underperformed in the last 12 months, so I guess that's one sector to look at in the coming months. Let's finish off on China today, and we'll take any questions at the end. So yes, China's reopening. It's now a pretty common story. Everyone knows the headlines. You know, when they came out of the lockdowns at the start of the year, everyone was positive about the reopening, and the first 2 or 3 months we saw a big change. But since then, we have seen slowdown in every aspect of the economy. This is the services PMI. They're starting to really slow down and on its way back. The manufacturing PMI, which we looked about earlier in other countries, is yes for China as well. Yes, it is coming backwards and not going up again. And the business activity, while historically, you know, this is a long-term chart from 2008 to 23. Historically, it's been pretty stable, with the exception of course, COVID and then lockdowns. But it had started to move up again, and it's now pulling back again. All in all, it's having an impact on the stock market. And China, while October last year had their lows around 15,000 points, just under 15,000, and while we saw recovery from 15,000 up to 23,000 pretty quickly, now it's down to 19 and threatening further downside. How do you see the world's second largest economy? This is very important for Australia, but also there's trading a little bit of a global, not a global, but a trade war with US again. So what are your thoughts on China, Angus?
Well, you know, the rebound hasn't gone quite the way everyone thought it would 6 months ago. And we're seeing that reflected now in the CSI 300. So, you know, rather than completing the right side of what looked like to be a bullish inverse head and shoulders formation, we're now seeing key support tested. Actually, I think this chart is of the Hang Seng, not the CSI 300, but nevertheless, the Hang Seng is also quite a good proxy for what's going on in China. So the key takeaway is we don't really want to see the Hang Seng break below that 19,000 level, which would then raise scope for a potential retest of those October lows. So caution is warranted. All is not going well in the world's second largest economy. I think the Chinese government are having a very hard time restarting it. And I think the property meltdown over there really knocked the stuffing you know, out of Chinese consumers. I think they're still getting over that. You know, the government threw everything in the kitchen sink to try and shore all of that up. But at the end of the day, you know, you can't make them go out and spend if they don't want to. And, you know, for some reason, a lot of Chinese consumers have shut their wallets. So it says to me that the Chinese economy is not out of the woods yet. And let's just keep an eye on the CSI 300 and, of course, this chart of the Hang Seng for the technicals to let us know what's going on in terms of the market internals.
Well, I guess if they come out with a stimulus package or some bonanza, then that might be something to look out for. But otherwise, yeah, it's important for Australian commodities because they import so many commodities from Australia. All right, we'll take a couple of questions and round up today. So first question is regarding the disconnect between the mega cap stocks versus the rest of the market. So this is from Rob. He's saying, is the disconnect because historically high growth stocks need large amounts of capital to realize their potential, and do our mega caps now need to borrow more?
I don't think the mega cap stocks need to borrow money. I mean, most of them have got balance sheets with mega amounts of cash on them. You know, Apple's carrying on any given day a couple of $100 billion. You know, they're all drowning in cash. So that's not the issue. I think the issue is that when you're on a multiple of 30 or 40 times, and you know, those multiples are very rate sensitive. You know, you can justify a higher multiple when interest rates are low, particularly for the you know, for the growth stocks that are growing at a higher percentage than the rest of the market. The minute you start to recalibrate the interest rate up, it puts downward pressure on those valuations. So, you know, optically, if the 10-year bond rate were to go through 4%, you know, we're going to start to see that putting some real pressure, I believe, on those valuations. That chart that we had up before of the tight correlation between the S&P tech sector and the 10-year bond yield, which is now broken down. We had that chart up before. It was an excellent one. We've seen this huge gap. Look, these gaps can persist for a while, but they won't last forever. And sooner or later, things normalize and they revert to the mean. And, you know, I think that with respect to this gap that we've seen in tech, I think it's really only a matter of time before that gap closes.
All right, excellent. Just another question on uranium from Peter is asking for a view on uranium. Do we like uranium? Do we not? What's, as an investor, what are your thoughts on uranium?
I think I'm bullish on uranium. I think uranium's headed higher. I think the world's got no choice if it wants to greenify itself. The uranium energy or nuclear energy has got to be part of the equation. I mean, renewables are great, but they're not going to supply all of the clean energy that the world needs. And we're going to need a lot of energy. We're going to need a lot of power, especially with all the electrification that's coming. You know, solar and wind and bio and all, you know, all those sorts of things are important, but we need a stopgap. And I think that stopgap, you know, I think we're going to see a big re-embracement of nuclear energy, particularly with some of these smaller modular reactors, which are pretty safe. And you know, there's no emissions. So bullish on the uranium price, and I think, you know, uranium stocks are looking really interesting. In fact, I will write uranium up. It's been a while since I've done it, but I'll write uranium up next week. Might even try and do it tomorrow if I've got time.
Excellent. Well, that'll be great for those people who are interested in your thoughts on uranium. That'll be good. All right. Now, one quick announcement before we wrap up today. We're based on a lot of feedback we've received from members lately, and also some internal findings. What we're going to do is we're going to trial a few changes in the webinar schedule going forward. We'll try it maybe for a month or two, and we'll see how that goes. So one of the changes, I think you may have heard in the research webinar earlier in the week, is we're going to trial fortnightly webinars for research and fortnightly for the macro. So what that means is we're going to look at doing one webinar per week. So it'll be on a Thursday, just like today at 12 p.m. So one week it'll be the research team talking about stocks, and the following week it'll be Angus talking about the macro, and so on. So it'll be alternating between research stocks versus macro. So we'll do this on a weekly basis every Thursday, because what we're finding is a lot of members saying that 2 webinars a week is probably getting a bit too much for them to keep up with you know, the recordings or live. They miss a few sessions, and then before you know it, it's the next one. So just to make it a little bit simpler, maybe we'll do 1 per week and see how that goes. If it's received well and people are finding it a little bit easier to absorb the information, then we will stick to it. Otherwise, we can always make some changes. So going forward, we will send you an email in the next day or two, so you'll know what to do. But it'll be every Thursday at 12 p.m. same time. So we will be making those announcements via email. So keep an eye on that. But apart from that, members, thank you for your company today. I know you're keen on getting into some stocks in the coming months if you're sitting on cash. But please stay tuned to our research and the advice. In the meantime, all the best in the markets. My name's Roger. Thank you for your company, and I'll pass it on to Angus for your final words.
Thanks, Roger. Always enjoyed doing the webinars with you, and thanks for everyone listening today. Look forward to joining you. Is it next Thursday or the following Thursday, Rog? Maybe it's I think it's not next Thursday, is it? It's going to be a fortnight from
the following one, yeah.
Yeah, so same time, a fortnight from now, and have a great weekend and bye for now.